The first rule of accounting is in the accounting assumptions group, and it is called accounting entity. So we're going to try and remember this by saying it's in the accounting assumptions, which is the A group, not the Q group for qualitative characteristics, and it's the first one, A1, accounting entity. What does it mean? Well, it's got a definition, and it says the assets, liabilities, and business activities of the entity, which is just another name for a business, are completely separate from those of the personal records of the owner of the entity. So basically what we're saying is there's the owner, that's an entity, and the business, that's an entity, and you've got to keep those transactions separate. In the business world, the owner is not the business; they're different things. The owner is one entity, the business is another. So we keep that separate from the owner's personal records. Also, the owner might own more than one business, so we need to keep the records completely separate between any other entities or businesses owned by the owner. And fundamentally, what that means is each entity must keep its own separate set of accounting records, including bank accounts, and prepare its own separate financial statements. How does that work in reality? Well, let's just take a basic example. We've got John here. John lives in Warragul and has some personal assets. So these are his assets as a person. The entity is the person, in this case, John. He owns a house for $700,000, a Ford Mustang for $80,000, and he's got $10,000 in the bank. He also owns a business, a plumbing business, and that has assets too. In this case, it's got $30,000 of tools, a ute for $60,000, and cash for $90,000. Well, under the accounting entity assumption, these are separate entities. The first entity is entity A, which is the owner, John, and then we've got entity B, which is the plumbing business. So like John might actually keep all these things for the plumbing business at his own house. So at his house, there are $30,000 of tools. There's a Ford Mustang and a ute in the driveway. And the bank accounts, he might log into his online banking and see both bank accounts in the same sort of user profile, but they're actually separate. These are separate legal entities. What that means is their assets and liabilities and their business activities must be kept separate. They must have separate financial records, including bank statements. Okay, so John can't use his own money to pay for things for the business, and the plumbing business can't use its money to pay for John's personal bills, for example. He shouldn't use the tools of the business in a personal capacity. The ute does not belong to John, and the Ford Mustang does not belong to the plumbing business, and so on. So another example. So that's where we keep the transactions of the owner as an entity separate to the transactions of the business as an entity. What about if John, who also owns the plumbing business, we said that in the last one, here it is, he also owns a dry cleaning business, and it's got some assets too. It's got $70,000 of washers and dryers, and it's got $40,000 cash in the bank. Well, now we've got three entities. We've got John as the entity, A, he's the owner. Entity B is John's plumbing business, and entity C is the dry cleaners. These are all separate legal entities. Again, their activities and their assets have got to be kept separate. They've got to have separate financial records, and so in practicalities, we say, yeah, you can't use assets from one in the activities of another, or use the money from one to pay the debts from another. Separate legal entities. And a really good way to think about it is this box. You say this box goes around each entity. Nothing else can enter or leave that box from one of the other businesses or entities. So that's how we think about it. Separate entities, separate transactions.